China might have hidden about $3 trillion from the United States. New research by economist Brad Setser from the Council on Foreign Relations suggests that they did this through state-owned banks and the Belt and Road lending system. This shocking revolution could have huge impacts on the world's economic system. China might actually have twice as much foreign cash saved up as we thought, making their currency stronger and less likely to crash, even under pressure like sanctions. Secondly, if China needs to defend its currency, it might quickly sell off assets from the Belt and Road projects, which could cause financial problems for those countries. It also seems that while many thought China had stopped tweaking the value of its currency to gain an advantage, they were actually still doing it, just in a way that wasn't as obvious. So how did China end up with all this extra cash, and what does this mean for the balance of power in the global money system? These are key questions that need answers. Over the past 20 years or so, China has been exporting a lot more than it imports. The key thing to understand here is that while China has its own currency, the renminbi, it mostly uses the US dollar for international trade. When Chinese companies import goods, their overseas suppliers usually want to be paid in US dollars, which are accepted worldwide. Similarly, when China companies export goods, they often request payment in US dollars since foreigners usually don't have access to renminbi accounts. Back in China, traders need renminbi to operate, so they go to their banks to swap dollars they earn from exports from renminbi or the other way around for imports. These banks, which primarily operate in China, then exchange these renminbi for more dollars at the People's Bank of China, the country's central bank. This ongoing cycle means the People's Bank of China usually ends up holding a lot of dollars, especially if exports are high. However, it might face a shortage of dollars if imports significantly increase. This dynamic is a crucial part of how China has managed to accumulate such a large stash of US dollars over time. Former Federal Reserve Chairman Ben Bernanke explains the countries hold large reserves of foreign currencies to protect their own currency from crashing, which could lead to severe inflation. Here's how it works. If a country's currency starts to drop sharply in value, it can use its reserves to buy back its own currency, boosting its value. The key is figuring out how much you need in your war chest to effectively do this. For a big exporting nation like China, you'd expect this reserve to be quite substantial. In an ideal economic scenario, once China has enough dollars, it wouldn't need to hold onto them, especially since they earn very low interest. Logically, it would start selling these extra dollars and buy back renminbi on foreign exchange markets. This action would make the renminbi stronger compared to the dollar. A stronger renminbi would make Chinese products more expensive abroad, reducing their competitiveness. Conversely, it would make American goods cheaper in China, boosting their appeal. This balance act is crucial in international trade and economics. As the value of the renminbi increases, China might find its imports surpassing its exports. To support these importers who need dollars, China's central bank would buy dollars on the foreign exchange market using newly printed renminbi. This action drives down the renminbi's value, boosting the competitiveness of China's exports once again. This cycle is part of a simple yet effective balancing mechanism in the global economy. However, the real world is more complicated. Manufacturing giants like China, as well as oil-exporting countries like Norway and Kuwait, have been able to maintain trade surpluses by exporting more than they import. In contrast, the United States has become predominantly an importer. Some U.S. economists argue that these countries keep their currencies artificially low by hoarding dollars instead of selling them off. This tactic keeps products from these countries cheaper in the U.S., which is great for American consumers because they can buy affordable goods. However, it also means that more factories are built overseas, leading to job losses and factory closures in the U.S., which has caused significant frustration amongst voters in America's industrial regions. This situation led politicians like Donald Trump to accuse countries like China of currency manipulation and to threaten tariffs in response. In 2016, despite China's trade surplus remaining high and the renminbi staying weak, China's official reserves appeared to shrink and then stabilize. The common belief then was that this was due to wealthy Chinese moving money abroad in search of better investment returns. But it turns out there was more to the story. It seems there was a scheme to hide trillions of dollars, allowing China to keep the renminbi low without being officially tagged as a currency manipulator. This revelation brings us to the pressing question: how exactly did China manage to hide so much money from America? To understand China's approach, it's important to know that China wants to keep its currency value low, even though its business earned a lot of dollars from exporting goods. However, these dollars are simply sold off. China needs a clever way to keep these dollars without making it obvious to economists monitoring its foreign exchange reserves. The solution was to redirect these dollars to different places while still keeping control over them to protect its currency. This was crucial to avoid a situation like Iran faced in 2012 with U.S. sanctions. China's strategy involved moving the dollar earnings from exports into large state-owned banks like the Bank of China and China Construction Bank. This move didn't immediately raise eyebrows among Western economists, who usually don't see banks as tools used by the state for economic strategies. For instance, if the Bank of England did something similar and transferred reserves to banks like Barclays or Lloyds, there's no certainty those banks would just sell off the reserves if it made business sense. And they wouldn't necessarily jump to defend the British pound unless it was in their financial interest. But in China, the government has a stronger hold over its banks, so even though the central bank governor can say that China's currency value is controlled by market forces, a closer look shows these market forces are largely influenced by the state. Economist Brad Setser discovered that once the state-owned banks receive these dollars, they don't operate like typical banks. Instead, they act more like branches of China's central bank. So, in essence, while it looks like market forces set China's currency rate, it's really controlled by state-run banks. This is a clever way of managing the economy, but there's more to China's strategy than just this. Around 2008, China realized that while holding dollars in foreign deposits or bonds was effective, it meant that they were essentially funding Western economies and banks, which also posed some risks. After the 2008 financial crisis, China began diverting these dollar assets into development banks like the China Development Bank and the Export-Import Bank of China. These banks used the funds under the Belt and Road Initiative to invest in neighboring countries, creating links from China to Europe. This strategy meant that the dollars China was accumulating weren't showing up in traditional reserve statistics. Instead, these funds were now boosting China's international interests by securing, for example, crucial commodities and geopolitical allies. This is how China managed to keep its currency value low without raising alarms among Western economists, who often view banks and development banks as more independent from government influence. The study by economist Brad Setser points out that just by looking at China's official reserves isn't enough. It's a valuable lesson for international economists, showing that other countries like Norway, Kuwait, and Singapore are also putting large amounts of foreign currency into investment funds instead of just in reserve assets. Countries like Turkey, Argentina, and Taiwan have used private banks to influence their currency values too. This revelation could mean that China's reserve could be twice as big as previously thought, making it about 5 times larger than Japan's, the second largest. The question now is, should economists rethink how they consider all policy institutions in their analysis? And should China stop its currency value low, or is this just part of how global finance operates? What are your thoughts? Let us know in the comments. And don't forget to like, share, and subscribe to Economy Obsession for more insightful videos.